If you or someone you know has a non-spouse partner that they're having a joint financial situation with, we're going to go through a number of interesting things here that you should be looking at to make sure that everything is situated accordingly for your specific situation. Now, when it comes to having a non-spouse partner, that may be I already was married, had kids, and now it's later in life. It may be, before kids, but anytime you're not married, it adds additional pieces that you need to at least be considering, especially if there are kids from a prior marriage. So looking here to help us today is Rachel Dakota. And these situations are very interesting. They have a lot of really great pieces that we can be focusing on here. So the normal stuff is when we're looking at a cash type of accounts, making sure, you have proper emergency funds and everything, which in this case, Rachel seems like she's doing a good job with. Next thing though, here in our next bucket, the taxable investment bucket. So here, Rachel has it set up as being a TOD. When you're dealing with a non-spouse situation, that may or may not be appropriate, right? Because a TOD, it allows the assets to pass directly to those beneficiaries, transfer on death. It does not go through the will. Now, in some cases, that might be great. You might say, hey, I want all of my assets to pass as simply and easily to my children. That's great. Then a TOD might be a perfect fit. In another situation, though, maybe you say, hey, I want some of my assets to go into a trust, or I want them to go to the benefit of my non-spouse partner while they're still alive or while they're still living in the home or something like that. In that case, a TOD may not be appropriate because you might actually want the assets to go through the will. So paying attention to how these assets are registered is very, very important to make sure they're fitting with what you're wanting to actually happen in the future. Same thing goes with all your retirement assets. Here you see that Rachel has an IRA, she has an annuity IRA, she has a non-qualified annuity, and she has a Roth IRA here. So first one here grows tax deferred, next one here also grows tax deferred, last one here grows tax free, and for a non-qualified annuity, the growth is tax deferred, but then when you get the original amount, the principal that you put into it comes back out, that comes to you tax-free. So they all kind of work in different ways. So it's important to understand how some of those differences may affect you. But for Rachel specifically in a non-spouse partner situation here, we're looking at, hey, who are the beneficiaries on all these accounts? Because just like the TOD is going to pass outside of the will, an IRA passes outside of the will, annuities pass outside of the will, Roth IRAs pass outside of the will. So whoever you have on here as beneficiary, that is who is going to legally be entitled to get the money, no matter what your will says. So again, depending on how you want your assets to maybe be shared with your non-spouse partner or be temporarily available to them, it's really important that you structure the beneficiaries correctly to do that. Lastly, here on the real estate, same thing. Here we're saying 50% is owned by Rachel, so $350 value in total of that. You want to, again, make sure that that's structured the right way. For example, let's say that this goes through the will and it goes directly to her children. Her children could say, hey, we want our 50% of the home. We're going to force you to sell it. When in real life, Rachel may want, her partner to not necessarily have to do that. So again, structuring all of these things in this type of a situation becomes a little bit more complex. If it was a more straightforward, husband and wife scenario, generally speaking, assets are always going to pass to the wife if the husband dies or the husband if the wife dies. And so that's a pretty straightforward situation. Again, if it's a non-spouse partner, you maybe meet them later in life, whatever it might be, now you may not necessarily want that normal chain of beneficiary to occur. So it's really important to pay attention how all these pieces come together. Lastly, just as an aside, you can see different account types that we've built in here. As if it wasn't complex enough, we threw a couple additional things in here. So when you're dealing with annuities, you always want to make sure you understand how they work and what the benefits are to them. Every annuity is its own unique contract between you and the annuity company. So they're not just necessarily for income or annuitization. Some of them could have different buffering, like RILA has, where there's certain downside protection on the assets. Some of them might have a long-term care rider to try to assist in paying if that care were to occur. So if you do have annuities, again, make sure that you really understand how those benefits work. And again, in non-spouse situations, let's say we have a long-term care rider that probably only covers the person whose name this is in. If it's an income rider, it probably only covers the person whose name it's in and most likely does not pass to that other individual. Likewise, when we jump into the more advanced planning side of things, This is where you need to pay attention to, hey, what's going to be true if we're both here? What's going to be true if only one of us is here? So here you might say, turn all of these off initially here. You might say, okay, well, right now, while we're both here and we both have, our own assets, maybe right now I can afford to pull out, $25,000 a year in this example to do more in the way of vacations. Maybe that makes sense. Maybe I can have that work. But what you also need to think about in these situations is what happens if this person is not here. So let's say that person is not here. Maybe you're relying on their Social Security, or maybe you're relying on their pension, which again, if you're not married, the pension is probably not going to transfer to you. So you have that to consider. And now with those additional expenses, one, can I afford that situation? And two, maybe I now need to scale down some of those things if something, God forbid, were to happen to my partner. So not to say that it is too overly complicated or something that can't be done, but there certainly are extra considerations that need to be made if you're in a non-spouse partner situation. So hopefully today's video provided some good talking points, good things for you to consider yourself if you or someone you know is in this situation, and more plan shares are on their way to come. Thanks very much.